need to begin by saying I'm pleasantly surprised at the resilience of the U.S. economy. The pace of interest rate rises that we have withstood with the relative lack of pain in the economy. By the way, I'm not saying that nobody has felt pain, but the relative lack of pain that we felt in the economy has amazed me. And in the near term, I would suggest that I'm bullish on the broad economy and equities, both because we've been able to withstand the pain, but also because there are literally trillions of dollars sitting on the sidelines. Investors are really cashed up. Before I come away as too bullish, however, I would suggest to your listeners that the effects of interest rate rises often lag, which is to say, as an example, the doubling of the 30-year mortgage rate has resulted in a slowdown in single-family residential sales. But we haven't seen wholesale price declines because people haven't been willing to lower the ask prices. What we've seen is a sort of a hiatus in transactions. And my guess is that as the impact of higher interest rates gets felt through the economy, that the reaction of the economy, that is the negative reaction of the economy, will start to pick up. I also would caution investors to understand that increasing interest rates are very bad for the long bond market and can be bad for the equities markets too. Bad in the sense that companies' costs of capital go up at the same time that the capitalized value of distributions, that is the competitiveness of dividends relative to other savings products, declines. I am amazed really at the resilience of the U.S. economy, but I remain very cautious in the face of higher interest rates. I think we have a chance for a rally, simply as a consequence of the fact that there is so much cash on the sidelines.
So you mean like near and it's going to be short-lived, and then what happens?
My suspicion is it will be short-lived.
Okay.
My suspicion is that we haven't felt the entire impact of higher interest rates. Higher interest rates are bad for almost all asset classes. But counteracting that has been the amazing resilience of the U.S. economy, the amazing resilience of earnings, and the fact that individual investors and institutional investors have so much cash on the sidelines. Remember that although the nominal interest rate has increased quite a bit, we still have negative real rates. Inflation is slowing, particularly if you do as they do, which is to exclude food and fuel. One would presume that the Council of Economic Advisors neither drives, nor eats. But it's important to remember that real rates are negative. And if we begin to see a lagging effect of interest rates in equities markets, but also in general economic activity, I suspect that the political pressure on the Fed to pivot will be very strong. I think we went through 40 years of benign economic climate, 40 years of declining real interest rates, 40 years of the benefits of demographics. And I need to say that with the exception of benefits that we will continue to enjoy from better technology and more inclusion in the workforce, I think those benign times are past us. Peace was breaking out around the world for 40 years. There was an inclusion of more people in the workforce. And in particular, we had 40 years of declining interest rates, both real and nominal interest rates. That party's over, I think, for a while. The consequence of that is that we need to adjust ourselves to a new normal. And 2022 might be a preview of coming attractions. I would note, too, that the decline that we had was a long, slow, grinding decline through many markets, but not the sort of sharp break that we experienced, as an example, in 2008. What you say is true with regards to the number of days that the S&P declined. The fact that the S&P didn't decline by more in the face of a doubling of interest rates and a doubling in the yield on competing products, I think really is testimony to people's belief in equities. I'm not sure that belief is well-founded, but I think what we saw in 2022 is something that we're going to need to become accustomed to.
I like that statement. I think it's an important one where you say it's more of a preview of things to come, of our new normal. Can you elaborate a little bit more on that? So enthusiasm in equities doesn't go away. Inflation
I think people are going to have to become stock pickers. I don't think that you're going to be able to buy the market, because I don't think that the market is going to have the demographic tailwinds. I don't think it's going to have the benefit of globalization. I don't think it's going to have a continued benefit from inclusion in the workforce, because female employment is running very close to male employment. I don't think that we're going to have the benefit of declining nominal or declining real interest rates. I think we will continue to have bright spots. I'm still delighted by the pace of American and frankly global ingenuity. We've talked before about the fact that our economy, despite our best efforts to wreck it, is still a place where 5 or 6 young kids can commandeer a garage in Sunnyvale, California, and out pops Google or out pops Apple. And that will continue. There will be problems. As I say, I think we're coming into a stock pickers market. I think that you're going to not need to find enterprises that add real value. I don't think that you're going to be able to jump on the US stock market as a whole. I don't think that you're going to be able to jump on one of however many thousands of ETFs exist and benefit from extraordinary economic tailwinds. But I also think that an investor who keeps his or her head and invests intelligently in businesses, not in the market, will continue to do extraordinarily well, just as Buffett did extraordinarily well in periods of time like the 50s and the 60s and the 70s and the 80s. I think there's going to be a lot of money to be made. It's just not going to be made as ubiquitously as it has the last 40 years.
Let's talk a little bit more about the U.S. economy, specifically the U.S. dollar. We've seen the brakes placed on the U.S. dollar a bit. From here, does it remain the strongest?
I think in relative terms, yes, it does remain the strongest. I think the U.S. dollar is the deepest, well, I don't think, I know that the U.S. dollar is the most liquid and also the most transparent market in the world. It's a freely convertible currency. I think that the United States government is doing its very best to wreck the dollar by weaponizing it, by extraterritorial imposition of U.S. law and value. In other words, we are driving China, we are driving India, we are driving Saudi Arabia out of the dollar to the best that we can. But the dollar as an instrument is probably so strong that it will defeat the government's efforts to wreck it. It's amazing how ironic that sounds. I know from my own experience with very large Asian pension fund investors that although they don't trust us, and although they don't particularly like the value proposition around the U.S. Treasury, they don't believe that they have any alternatives with regards to the depth and liquidity and transparency in the market, which is to say, as little as they trust us more than they trust the other superpowers and trust us more than they trust each other.
Why would they are they purposely wrecking it or blindly wrecking it? And if they're purposely wrecking it, why would they want to do that?
I would argue that there's a little bit of both, but mostly they're blindly wrecking it. I think the political class in the United States doesn't know and doesn't care very much about a free economy. They know and care a lot about politics and power. And trying to enforce U.S. foreign policy goals often means debasing the trust that the rest of the world has in the U.S. as a consequence of trying to export U.S. values and laws in an extraterritorial sense. To the extent that we want to fight China, rather than trying to outcompete them in the economy, we try to hobble them by restricting their access to our currency. That in and of itself debases the trust that China might have, as an example, in the U.S. as a global